Good afternoon. I'm Mr. Mshama, here with you today on our new lesson on the new topic by the name of Protectionism and Free Trade. The topic is under economic pursuit. So you can expect this topic in your examination, especially in June exam. You can expect it in your question 1, question 3, as a part of question 4, and question 6. The name of the topic is Protectionism and Free Trade. It's under economic pursuits. This is our paper. So the subtopic to cover for today, we are not covering the whole topic because it's long, but it's broken into 2 parts. The first part here that we're doing is export promotion, import substitution, and desirable means or economic integration. This is the only part that will be covered today. There will also be an assessment at the end of the lesson. There is also a worksheet available for you to work on as you check the level of your understanding over this today's lesson. So please join me. Let's see what we have in the pocket. The following are the lesson objectives that will be achieved during the course of this lesson. So after this lesson, we'll be able to discuss in detail export promotion. So if we say in detail, we mean this is an essay. It's a part of your section C. You can expect this question in your examination, either June exam, preparatory examination, or November, December examination. You can expect this kind of the question in your question number 6, or in section B, if it's not a part of section C. In section B, it can be a part of question 3, the question 4, and also in question 1, it can be found. So we'll be able to discuss export promotion in detail. It goes with reasons for export promotion, also goes with the methods or approaches, advantages as well as disadvantages. The second part, we'll be able to discuss import substitution. So briefly discuss import substitution, meaning this one is not a part of an essay. You can expect this question to come in, this topic to come in the same question that I mentioned before. Can be in section A, section B. It can also come for minimum of 1 mark to the maximum of 10 marks if it's an additional part. You can also expect this type of the topic for 8 marks discussion questions. This lesson will also allow you or equip you to be able to briefly discuss desirable mix, which is known as a part of economic integration, where countries get together to form trade blocs so that they will easily import and export goods among each other. The following are the basic concepts that will assist you to understand this lesson. Firstly, we have export promotion as the main topic here that we are starting with. So these are measures taken by the government to increase the quality and variety of goods and services exported. So in this case, if the government implements export promotion, it uses subsidies and incentives to support local exporters to produce more goods for the foreign market. This is done to ensure that local businesses that are exporting are able to produce more goods at the lower cost, so that they will then export goods at the large quantity foreign countries or the foreign market. Import substitution. So this refers to measures undertaken by the government to replace former imported goods with locally produced goods and services. If the government implements this policy of import substitution, it tries to ensure that goods that were imported before are now produced locally, to ensure that a local economy can be diversified. There can be variety of goods and services, and also consumers can have variety of choices available for them. Instead of depending in foreign countries to produce goods for them, they decide to produce those goods for themselves instead of them. The dumping. Dumping is the selling of goods at a lower price than the cost of production in the country of origin. So this simply occurs when a country simply sells goods in the foreign countries at the lowest cost than in the country of origin. So these goods become even more cheaper than the cost of production or the cost of their production. Embargo. So we normally call this one a trade embargo. It's an official ban of trade with a particular country. We call that a trade embargo. Sanction is a penalty imposed by one or more countries to other countries. So sanctions, we've seen that they've been lifted against one of African countries over the past week by the US and other countries. So if the country is being sanctioned, it is not allowed to trade with other countries. for the particular reason. So this is the lesson body. We have export promotion, import substitution, as well as desirable mix and economic integration. So these are the topics to be covered today. So if I can brief you about export promotion, in this case, we refer to the use of incentives and subsidies by the government to encourage local producers to produce more goods and services for the foreign market. So this is done because we know that foreign markets are bigger than local markets. So for businesses to be able to cope for the foreign demand, the government must intervene to support them to produce those goods in large quantities so that they can be able to serve the local market and also the foreign market. So they deserve the support from the government, which comes as a part of the export promotion. So in this case, all of these incentives and subsidies, who is responsible to ensure that they are covered? The Department of Trade, Industry and Competition is responsible to ensure that all of these incentives as well as subsidies are given to this business so that they can be able to produce more goods and services for the foreign market at the lower cost. If ever the state intervenes by giving export subsidies, that will mean those exporters will be giving, export subsidies can be in a form of either direct or indirect subsidies. So if there are direct subsidies, those can be in a form of cash or grant that is given directly by the government to those exporting businesses so that they can produce more goods and services at the lower cost. And those goods can be produced for the foreign market. So be aware of the fact that the direct subsidies result to government expenditure because the government will be spending money giving it to business so that they can be able to produce more goods at the lower cost. If the business is given the subsidy, it gets the capability of producing more goods because it will be having enough capital. That subsidy adds to the capital the business is having so that it can produce more goods and services, the financial capital. And then also the direct subsidy will always result to less cost of production, which become an incentive to business to produce more goods and services. And then if we talk about indirect subsidies, in this case, we refer to the support that is given by the government to exporting businesses to produce more goods and services at the lower cost for the foreign market. It does not include the direct finance. And also, this does not lead to the government expenditure because government does not give them money, does not spend on them. However, there will be some benefit that they will be getting from the government that will be encouraging them to produce more goods and services for the foreign market. In this case, we refer to the likes of tax exemption or tax concessions. That's when the government intervenes by maybe giving exporting business the support of not paying a certain percentage of tax. So the tax on their profit cannot be paid maybe at a certain percentage so that they can use that money that they were supposed to pay for the tax to improve their productivity. We call that a tax exemption. When the business is exempted from paying tax, that means it is prevented or not allowed to pay tax for the fact that it is being supported by the state to produce goods for the foreign market. The same as tax concession. That refers to the taxation that businesses are not given an opportunity to pay on their revenues. If the business is making a profit, then the business will be allowed not to pay a certain percentage of tax or completely not to pay a tax on its profit so that it can take that money or those revenues and produce more goods and services so that it can export into the foreign market. Number two, we talk about the tax rebate. If we talk of tax rebate, we talk about the taxation that the government will return back to the business or to the exporting business so that it can be able to produce more goods and services. So in this case, the business will be paying a taxation in full percentage. However, the government will intervene by returning a certain percentage of the taxation to the business so that it can be able to use that money to produce more goods and services. We call that a tax rebate. And then also, we talk about the government surety. If we talk of government surety, we refer to an incentive for the benefit or indirect subsidy given by the government to the exporting businesses, which contains the agreement between the government, the exporter, and the commercial banks that allow a business to access a loan from the commercial bank at the lower cost or at the lower interest rate at the expense of the government. We call that the government surety. We also have incentive that businesses will be receiving from the state or from the government as a part of the export promotion. In there, we can talk about maybe the low-cost storage. When businesses have to export their goods into the foreign markets, those goods go through the storage, and storing goods is expensive. So the government intervened by giving them a discount or giving exporters a discount on the storage where they will be storing their goods as they go to the foreign market. We also talk about the cheap freight or low transport cost. The state intervenes by giving this incentive to exporters to transport their goods to the foreign countries or to the foreign market at the lower cost. And then also, we talk about the state intervention on market research. The government also intervened by doing the research on the competitors for our exporters abroad. The government will be sending its own authorities to do the research on behalf of the business. As those authorities are doing the research, the business will be paying nothing for that. So it is given, the information is given to our exporters free of charge. So they do a research based on the competitors, the target market, and that information also is given back to our exporters free of charge so that they will be able to get there and know who is their target market, who is their competitor, how can they improve their product compared to those of the competitors abroad. So those are some incentives that are enjoyed by our exporters. We also talk about free advisory schemes. Free advisory schemes are given by South African government to our exporters. They normally receive the free training and free workshops so that they will become more efficient as they produce goods and services, so that they can simply adapt easily in the foreign market. They will be given that pure information in terms of workshops and training to improve their efficiency in the global market. It goes together with the business intelligence, which is also given to entrepreneurs that are the exporters, so that they can be able to improve their knowledge about the foreign market. Then they will be able to come and plan that information to their producers within South Africa. Then when they export goods, they are already informed about the entire global market on their particular product that they are exporting to the global market. Those are some incentives that are enjoyed by South African exporters into the global market. Remember that the department responsible for this is Department of Trade, Industry and Competition. There are some advantages and disadvantages over export promotion. It is good to have export promotion because that allows a business to have high demand for labor. There will be more demand for labor because as businesses are supported to export, to produce more goods and services, then they will be demanding more labor and employing more workers, which will be good for South African economy. It also results to the increasing productive capacity for our exporters, which will result to more productivity as well as more economic growth. Also, remember when we were doing the foreign exchange market, we spoke about the trade surplus and trade deficit. If ever exports are supported by South African government, our export volume can increase further than imports volume, which will lead to our trade surplus. So those are some advantages of the export promotion. It can also result to our businesses improving their efficiency because they will be exposed into the international market, competing with variety of businesses. Remember that the foreign markets are bigger than the local market. So if ever the business is exposed to the foreign or internal market, it is able to compete in the open space that allows the business to even be more efficient, meaning it will be able to use its resources at the optimal level. Then what is bad about this policy of export promotion? The bad thing is the fact that the cost of production is hidden. If ever the state intervenes by providing all of these incentives and subsidies to our exporters, the cost of these incentives are not really given to the business. The business will only receive the direct subsidy, which is a cash, which is known. Otherwise, the rest is unknown. For instance, if we talk about free advisory schemes, business intelligence, also we talk about low-cost storage, cheap freight or cheap transport costs, market research, those costs are not given to the business that is exporting. It is not aware of the amount of those costs. So the business might think it is making a profit while it is not even making a profit because the cost of all of these incentives is not known by the business. It can happen that the business is thinking that it is making about 30 million profit
while the business is operating at a loss, because all of these costs for incentives as well as the subsidies are not well known by the business. They are only known by the government. So that's a challenge. So the actual cost of production is hidden, which results to the cost being distorted. They don't get the true reflection of the cost of production because they don't actually know how much they spend in production if they add together incentives and subsidies that were given by the government. The other disadvantage is the fact that if local businesses that are exporting are highly subsidized by the government, it can happen that the foreign businesses in those foreign markets are not well subsidized. So it will result to unfair competition now, because local businesses will be holding on subsidies and incentives while foreign businesses are not having those incentives. So that will be resulting to our local or South African businesses selling goods at the lower cost compared to those foreign businesses that will be selling at the higher cost, which creates unfair competition in the foreign market. And it can drive out those foreign businesses out of the market because of the unfair competition if they are not subsidized. The other issue here is our goods or South African exported goods can be seen as dumping, because if these goods are sold at the lowest possible cost abroad, that will mean they will think that our goods are the part of dumping, and that will lead to the price war, because they will decide to impose some tariffs as a part of retaliation to South African exported goods and services so that they will become even relatively expensive abroad. So that's also a challenge that is caused by the export promotion. So they will be discussing detail. Then we talk about the import substitution. If we talk about the import substitution, we refer to the policy where the government replaces former imported goods with the locally produced goods and services. So in this case, the import substitution can occur in two forms. It can be voluntary import substitution or the forced import substitution. If it's voluntary, that means the country decides on its own to produce the product that is the former import. So it stops importing the product and produce the product on its own. So that was done in South Africa. The example of that is ISCO, the South African steel company that was formed or that was established to ensure that South Africa does not mainly depend on foreign countries for the steel. It was created as a part of the what we call voluntary import substitution. We have the forced import substitution. That one occurs when the country has been banned or sanctioned to trade with other world countries. So the country does not have a choice for it to ensure the social security. It has to ensure that it produces that product on its own. For instance, the Denel or Armsco was formed through the forced import substitution form in South Africa, because South Africa was sanctioned from trading with other world countries. So the forms of import or the methods of import substitution include import tariffs that can be known as import taxes or custom duties. And then also it takes also the form of what we call import quotas or import limits, whereby the government intervenes by limiting the volume or the size of goods to be imported to South African economy, because the South African business can also be able to produce those goods and services. It also take about the likes of physical control. That's when some goods are totally banned from being traded or from being imported to South Africa, or countries are sanctioned. And then also we call that a total ban. And then we also talk about some obstacles that can be used by the government. For instance, delaying issuing trading licenses or certificates for businesses, delaying paperwork so that business can import their goods and services. It can also take the form of the government ensuring that it increases the quality standards of goods to be imported, ensuring that goods at the lower standard cannot enter the country. So that can lead to import volume being reduced. We will discuss a lot on that. There are also advantages and disadvantages. Then we'll be moving to desirable mix or economic integration, where we talk about the use of both export promotion and import substitution simultaneously, or when the country chooses to use export promotion first, then using import substitution. And then we'll talk about economic integration, whereby countries form some trade blocks to work together so that there will be easy form of importation and exportation. That's why we talk about economic union, we talk about the common market, we talk about the monetary union. So we'll discuss all of those aspects So here we discuss export promotion, which is known as involving incentives to encourage local businesses to produce goods for export or to be sold into foreign markets. It is the government's strategy to promote local businesses to produce goods and services for the foreign market. So the aim of this is to ensure that goods are not mainly produced for the domestic economy, but they are produced for being sold in the foreign market. Why does the government intervene to ensure that that happens? So that local business can be able to be very much competitive abroad, so that local goods and services can be exposed into the international market, so that we can be able in the country to earn the foreign currency. Export promotion is the outward-looking policy of export and international competitiveness. It ensures that our local goods and businesses are able to be competitive abroad. It can also be defined as measures taken by the government to increase quantity and variety of goods and services that are exported. We continue. It aims at achieving significant export-driven economic growth. If the economic growth is export-driven, that means it is more intensive on exported goods and services. So the country wants to ensure that most goods are produced and sold abroad, so that we can have effective economic growth. Because remember, like I mentioned, the foreign markets are bigger than local markets. If ever our business are exposed to the foreign markets, that will mean they will be able to produce even large volume of goods and services. Export promotion policy improve productive capacity of the country, since it leads to establishment of new businesses. If ever the government uses this policy, new business can be established in South Africa, so that they can produce goods that are highly demanded in foreign markets. Large-scale production takes place since export markets are bigger than the local markets. This leads to job creation. Obviously, there will be high level of productivity within the country, production within the country, because there will be huge demand for our local goods that are produced in South Africa in the foreign market. So that will lead to large-scale production or mass production or production in large quantities. Mass production leads to lower cost per unit. Local firms can be competitive in the international market. So this allows our business to be very much competitive. Our goods will be very much competitive in the foreign market because of the mass production. What are the reasons for the export promotion? The first step towards export-driven growth is to implement policies to encourage establishment of new industries. Whenever there is export promotion, new industries will be established to produce those goods that are highly demanded in foreign markets. Improving the performance of the manufacturing and service industries. This really improves our manufacturing sector, because they will be able to give the value in the primary sector, raw material, and sell those final goods into the foreign market. Ensuring the optimal use of resources, especially the refining and processing of natural resources. Our natural resources can be processed into final goods and be sold abroad than having to sell them at the primary stage or natural stage. In that case, they have less monetary value because they are less value added. Export promotion enlarges production capacity of the country. Yes, if ever the country is involved in export promotion for variety of products, that will result to large productivity of the country and resulting to more demand for labor and more economic growth within the country. So the following are the methods or approaches to the export promotion. We have the direct subsidies, which include the cash or grant given by the government to local exporters so that they can produce more goods at the lower cost per unit. And then indirect subsidies. This includes the financial support or non-financial support that is given by the government to exporters so that they will be able also to produce more goods. In this case, indirect subsidies will not result to the government expenditure, because no money is actually budgeted by the government to be given to businesses. Trade neutrality. That's when the state intervened by giving our exporters the subsidies that are equivalent or that are in proportion to the amount of taxation on their on their capital or machines or equipment that they have bought. So those machines, remember, they were taxed. So that tax will be paid back by the government in a form of trade neutrality as a part of subsidies. Incentives. So we talk about all benefits that are given by the government to local exporters so that they will be able to produce variety of goods into the global market. So if we talk about the direct subsidies, we talk about a payment in a form of cash that is given to domestic producers who are aiming to produce goods for the export market. So they are given money in a form of cash or grant. These measures are described as direct subsidies because they result to the government's expenditure. So whenever the government have to budget for this money, so that's why we say they result to the government expenditure. It refers to the cash grant paid by the government to local exporting businesses as financial support to increase their production. Businesses are given this money by the government so that they will be able to produce more goods at the lower cost. This allows them to improve the quantity and the quality of goods they produce for the foreign market. Directly subsidized businesses have an ability to produce at the lower cost, increase international competitiveness, and explore and establish market overseas. So they get an opportunity to produce goods at the lower cost because of those direct subsidies. They can also be very much competitive abroad because their goods can be able to compete easily with the foreign goods and services due to the fact that they won't be highly expensive. And then also, there will be markets established abroad for our locally produced goods and services. Then we talk of indirect subsidies. They take a form of the tax rebate, which I've already mentioned, tax exemptions or tax concessions, the government surety, refund on import tariffs, the trade neutrality. These are the part of indirect subsidies that are offered by the government to local exporters or exporting businesses. So as a part of the support for them to produce more goods for the foreign market. So indirect subsidies are not, do not result to the government expenditure. They are exemptions given to exporting businesses. The government does not budget any money to be given to business in this situation. They're just giving some refunds on what they've already paid to the government. So in this case, we call these indirect subsidies. They don't result to the government expenditure. They are not in a form of cash. Indirect subsidies have the same effect as direct subsidies because they result to exporting firms using their discounts to increase their productive capacity. So it allows them to produce more goods at the lower cost, the same as direct subsidy. So we have tax rebates. If we talk of tax rebates, we refer to tax refunds given to exporting businesses to increase their production into the foreign market. So they pay the normal tax that they have to pay on their revenues. After that, the government will be refunding them back a certain percentage of tax that is known as a tax rebate. That refund can be used to finance their productivity. Tax rebate occurs when exporting businesses are given back portion of taxation they have paid to be directed to production. So the money that is given to them back can be used to further their production purpose so that they can produce more goods and services. We continue tax exemption. So in this case, we refer to tax discounts that are given by the government to our exporters so that they can take those discounts and produce more goods and services. So refers to tax discounts given to exporting businesses as a support so that they can increase their production. We call those tax exemptions. These are also known as tax concessions on profits earned by exporting businesses. On their profit that they have earned, the government can also give them some concessions so they will not be allowed to pay a certain percentage of tax because that's supported as a part of export promotion. Refunding on import tariffs. This is given to companies that often use imported machines to produce goods. So if ever the business is using imported machines or capital to produce goods, the government can intervene by giving them some refund. So remember, if the business is buying the machine abroad, that machine will be taxed. So that taxation on those machines will be refunded back by the government. In South Africa, we call that refunding on import tariffs. Export businesses are refunded their import duties or tariffs on equipment. Whenever they buy equipment from abroad, the government or the South African government will give them refunds on those machines. We continue. The government surety. So in this case, we refer to the interest rate discount that is given by the government to local exporters. It contains the agreement between the government, the exporter or exporting business, as well as the commercial bank, to allow the business to get a loan for export or the capital at the lower interest rate at the expense of the government. This allows local exporters to produce more goods and services for the foreign market. Government surety contains the formal agreement between exporting business, government, as well as the commercial bank to give the capital or a loan to exporting business at the lower cost at the expense of the government. That means if ever interest rate payable should be 22%, that will mean then the government can give this business, this exporting business, the government surety. Then it goes to the bank to sign the agreement to say maybe the actual interest rate that will be paid by the business will be 11%, and the government will be responsible for another 11%, which is a part of the agreement as a government surety. It allows the business to be able to get capital at the lower cost and produce more goods and services for the foreign market. Trade neutrality refers to subsidies equal to import duties imposed on exporters. Whenever goods are exported to the foreign market, they are taxed by the foreign government. So that taxation is reversed by the South African government. So if that taxation is reversed or returned back, it is returned on a form of trade neutrality, in a form of a subsidy that is in proportion to the amount of import tariff paid by the business when it was exporting its goods into the foreign market. Remember, as imported are taxed to South Africa, our exports are also taxed. So that taxation that is paid by our exports abroad will then be paid by the government back in a form of a subsidy under the name of trade neutrality. Remember, if ever our exports are being taxed abroad, that will mean they will be becoming relatively expensive abroad. Then the government will intervene by refunding our businesses those import duties or tariffs under form of the trade neutrality, which will be making our goods not to become expensive abroad. Trade neutrality subsidies are paid by the government to the local exporters. In this case, the government is trying to neutralize trade in a way that our exports do not become expensive. Even if they've been taxed, the government provides a subsidy which is equal to that taxation on import that was imposed by the foreign government on South African exported goods and services. Trade neutrality produces cost and increases the productive capacity. Then we talk of the incentives. So incentives are given to exporting business to encourage them to produce more goods so that it can export them into the foreign market. So incentives allow our exporters to produce goods in the large quantities. It allows exporters to produce more goods at the lower cost so that they can be sold into the foreign market. Those are incentives. So the purpose of incentives is to improve producers or producers' efficiency in the international markets. If ever they are given incentives, they are given extra benefits so that they will be able to use less money in their production, so that they will also be able to be very much efficient in foreign markets. Incentives enable exporters to export greater volume of domestic goods, thereby increasing economic growth. It allows them to produce the large quantities of goods to foreign markets, which will always lead to high level of economic growth within the country. The Export Market and Investment Assistance, which is EMIA program, was formed by the government to promote exports of South African products and encourage the foreign investment. So EMIA was formed by the government to promote our local exports and also encouraging the foreign direct investment into South Africa and out of South Africa. We continue with the incentive. Exporting businesses enjoy benefits such as the free advisory schemes, which are all about the local exporting businesses giving those ongoing workshops and training so that the staff can be more efficient. It will be more informed about the foreign markets. We talk about business intelligence, whereby entrepreneurs are trained regularly by the government authorities so that they will be able to be capable to compete in foreign markets where there's a high level of competition. Cheap freight, in this case, we talk about the low transport cost at the expense of the government, whereby the exported goods and services will be transported at the lower cost at the benefit of the businesses. Low cost storage, in this case, we refer to a situation whereby the government give exporters the discount on storing their goods and services as they go through the foreign market. Marketing and advertising. The state intervened by doing a research on behalf of local businesses about the foreign markets, and that information is given to local exporters free of charge so that they will be able to be more efficient. They know their target market, they know their competitors, they know the standard of their food that they should be producing for the foreign market. Also, the state intervened by ensuring that these businesses get the good publicity abroad. Our goods that are exported are getting the good publicity abroad so that they will be well known. Then there will be high demand for these goods in the foreign market. The government, through Department of Trade, Industry and Competition, DTIC, pay for all of these benefits extended to exporters. So our exporters will be receiving all of these benefits, and they will be paid by the Department of Trade and Industry, as well as what we call the competition. Information on export markets is made available to exporting businesses free of charge. That is under the market research, whereby after they have done the research on behalf of exporters about their market and target market, and also the standard of goods, and also the business environment where they should be putting their, they should be selling their goods to, then this information is given to our exporters free of charge so that they will be well informed, and then their duty will be to produce and sell abroad. Research with regards to new markets is conducted on behalf of local exporters so that they become effective in the global market. Concession on transport or cheap freight charges from the interior to harbors, for example, are given to exporters to ease the cost of the transport. Remember, the cost of transport is very, very high. So for the government to support local exporters on the cost of transport, it intervened by giving them concessions on the transport or cheap freights, making it more relatively cheap for them to transport their goods across the country. Internationally. And then export credit. And export credit guarantees is given exclusively to exporters to access required capital. It is relatively the same to what we call the government surety, because it also allows them to get more credit from commercial banks as they want to access the capital for them to produce goods for the foreign market. What is good about export promotion? Expansion into the international market. Local business can expand to foreign market because of export promotion. Decrease unemployment. Remember, if ever there's export promotion, that will mean there will be greater demand for labor because new industries will be established. There will be greater production for goods and services, which requires more labor force or workforce. Then people will be employed, which will be reducing unemployment. Reduces prices. Remember, if ever export promotion is in place, there are subsidies and incentives that allow business to produce at the lower cost, which will be benefiting consumers to access these goods at the lower cost. Stabilizes the currency. Remember, if ever our exports are increasing faster than imports, we will be having the greater demand for the foreign currencies and more supply of our currency, which will be stabilizing our South African rand. Improve the base of payment. So we know that if ever exports surpass imports, that can lead to what? That can lead to trade surplus and also the current account surplus if our exports are more than imports, because there will be more inflow of money as a payment for exports and less outflow of money as a payment for imports. Diversify the economy. Large variety of goods and services are produced. So there will be economic diversity because there will be variety of markets being developed locally and abroad for our goods and services. Most of the goods will be produced in different levels for the variety of countries and variety of markets globally, which will be resulting to economic diversity. It will be no longer depending on the primary sector resources. Will also depend on manufacturing sector and also the services sector because of the export promotion. So here they are discussed expansion into internal markets. So the internal markets are bigger or larger than the local markets. We know that if ever you are exposed to the foreign market, your goods will be demanded locally and abroad, which will be allowing you to grow quickly as a business because there is a greater demand for your goods and services. Export promotion enables producers to produce large output to supply large international markets. So because of the export promotion, our local exporters will be able to produce variety of goods at the large volumes, at the large volume for the variety of countries, which is the part of different international markets. This creates an opportunity for economies of scale. We know that if ever there is a large productivity at the lower cost, that will lead to mass production as well as economies of scale, which can result to specialization. Because of what? If ever the government intervened by supporting business to spend less on production, that will lead to business producing more goods at the lower cost per unit, which is known as now economies of scale, because they're producing more goods at the lower cost and sell them at the lower cost. That is economies of scale. And local businesses that are exporting will get an opportunity to specialize on goods that they are good at. Producers are then empowered to optimize their utilization of resources and become more competitive in the global market. This employs efficiency. Our local exporters will be more efficient as they will be able to optimize their resources, such as factory production, as they produce, because there is a greater international demand for their goods and services. decrease unemployment and increase employment. The increase in productive capacity for the country increases the demand for labor. Yes, there will be more demand for labor because of the export promotion due to the fact that there will be establishment of new industries. Increased employment is a mechanism to poverty alleviation. That will mean this will automatically lead to a decrease in level of poverty because people will be employed and they will be earning income. High employment creates an opportunity for a government to earn more tax revenues on income and consumer spending to make provision for public goods and services. So this will lead to greater revenues earned by the government on the income that is spent by consumers as they buy goods and services, and also by workers as they are employed. Reduces prices. Large market sizes promote economies of scale, which reduces the price of goods and services. So goods become relatively cheap because of the large market. This increased standard of living because the volume of goods, consumers can buy with less income they earn. So as consumers are earning less income, they will be able to demand more goods and services because goods will be relatively cheap due to the fact that there is an export promotion policy in place. And the foreign currency. So export promotion and the foreign currency for the country. There are export earnings that are received by the country. The increase in the volume of exports increases the inflow of foreign currency as an injection into the South African economy. We know as we earn income on export, that is regarded as an injection. So there will be more inflow of money as a payment for exports to South Africa, which is the good thing for the economy because it results to welfare gain for the South African. This increases the value of domestic currency as foreign currencies are exchanged for rent. Then we continue advantages, improve the country's balance of payment. So high level of export reduces the trade deficit on the current account as more goods are exported than those that are imported. This only occurs when exports exceed imports. This reduces the country's balance of payment deficit and resolve the issue of the balance of payment disequilibrium. There will be no huge gap on the surplus and deficit. So in this case, the BOP deficit will be reduced. As South Africans, we know that we are faced by BOP deficits, which will be reducing our BOP disequilibrium if exports are increasing faster than imports. Diversify the country's economy. Export promotion results to variety of goods produced by local producers as they expand. Remember, there will be more goods being produced by our domestic producers. Even those that were not produced before can be produced because there's a greater demand for them in the foreign or international markets. That will be resulting to our economy becoming diversified. If the economy is becoming diversified, it means we don't mainly depend on one source of economic activity. We depend on variety of economic activities. We can depend on tertiary sector, we can depend on secondary sector, we can also depend on primary sector, and depending only in primary sector. That will mean now we are not selling or producing value-added goods and services. New businesses are established as they are attracted by the government incentives. So there will be variety of goods, of business being established for different services. They will be established because they are attracted by the government incentives that are given in a form of export promotion. Variety of goods and services are produced within local economy, and these can result to the country's economy being diversified. So there will be a growth of the economy and economic diversification because of the fact that there will be variety of goods being produced domestically. Prices are distorted. So in this case, we are moving to disadvantages. What is bad? As much as there are so many good things about export promotion, there are also bad things. Prices become distorted. They don't give true reflection of the cost of production. Because, like I mentioned before, that our exporters will not be informed of the actual cost of production because of incentive that they were given to them. They were not counted and no invoice was given to them. And then subsidies, especially indirect subsidies, it is difficult for them to get the sum or the amount of the benefit that was given to them by the government. Therefore, that will result to prices becoming distorted. They won't be given the true reflection of the cost of production. And there will be price war. So if our goods are becoming relatively cheap abroad because of the export promotion, foreign business can intervene, or foreign government can intervene by retaliating. So as they do so, they will be increasing the tariffs on South African exported goods and services to force them to become relatively expensive. Local export can be seen as dumping. If ever our goods are highly, subsidized or given incentive, they will be very cheap abroad and they will be selling at the lowest possible cost. And that will be leading to what? It will be leading to foreign countries seeing our goods as a part of dumping, which is prohibited by the World Trade Organization. Local firms cannot compete in the open market. Yes, this one is also important. If ever the state can intervene by reducing all of those incentives and subsidies, can our local business that were supported be able to compete in the open market where there's no government intervention? The answer is no, they cannot be able to compete in that particular market because there will be no longer those subsidies and incentives that were given to them before. So it will be difficult for them to continue. They will be producing at the higher cost and selling at the higher cost, and they will be facing abnormal, unfair competition, and that will lead them to shut down or exiting the foreign market. Inefficient production. So our local business become more inefficient because they are supported through subsidies, basically. They are not mainly using their own capital. Subsidies are the main that are supporting them to produce more goods and services. Increased tariffs and quotas. So the foreign countries can intervene by increasing tariffs and quotas as a part of retaliation to ensure that our goods are becoming expensive in their countries, then becoming cheap because they are forcing their businesses out of the market. So these are some of the disadvantages. So prices are distorted. Prices of products are not a true reflection of the cost of production, like I mentioned before. Subsidies and incentives given to producers make goods appear cheaper than they are. So these goods will be relatively cheap than they should be. They'll be costing a lower cost than they should be because of high level of subsidies. Prices play an important role in determining the demand and supply in the market economy. The state intervention on pricing results to less profits earned by businesses. The government intervenes based on subsidies and incentive offered to ensure international relations and profit maximization. This one is also very important. Note, when the state intervenes by giving the exporter subsidies and incentive, the state will also intervene when the firm decides to determine the price for the product. If the firm wants to make the product more expensive, the state can intervene to say, no, the price cannot be relatively high because we gave you incentives and subsidies to ensure that you produce these goods and services. Therefore, the price must be lower, which now is a bad thing because businesses are no longer having much say. The government intervene on the price determination. So remember, the state is only concerned about international relations whenever it's trading with other countries. So if our goods are relatively cheap abroad, that will mean the state is trying to make those relations to be good. For instance, if our commodities are cheap abroad, that will mean that country is benefiting from South Africa. So for that sake, the state will ensure that those commodities are relatively cheap because the company was supported through export promotion policies, which include subsidies and incentives. So that will mean that the firm does not have the huge say on the price, but the government also has a control because of incentives and subsidies that were given by the government. So the firm cannot simply dictate on the on the profit it wants to achieve because the government will intervene. The firm will have less say. The price wars. Export promotion will lead to what we call unfair competition if foreign competitors are not subsidized by their government. If our goods that we sell abroad are subsidized, their goods in that foreign country where we are selling our goods to are not subsidized. I mean the goods of the same nature are not subsidized. That will create unfair competition because our goods will be cheaper compared to those goods of the foreign country in that particular country, resulting to unfair competition and also driving those businesses out of the market because we are competing with them by selling the same goods with them that for them are expensive, but for us are relatively cheap. This drives foreign producers out of the market. So those foreign businesses abroad will be going out or will be leaving the market because they will be facing unfair competition caused by our export being highly subsidized and also being more cheap. Price wars can occur and result to fewer variety of goods being made available to consumers. So there will be the fight between those businesses over the price, or whereby they will be competing over the prices in there to avoid to leaving the market those foreign businesses. Local exports can be seen as dumping. Dumping occurs when the firm sells its goods in a foreign country at the lower price than in the domestic market. and even then the cost of production. This enables the firm to gain market share and push local producers out of the market because its goods will be relatively cheap compared to those other goods because of the subsidies that are given to the firm. It can be against the spirit of the provision of the World Trade Organization, WTO, which support the notion of no dumping to foreign countries. South African exports can be seen as dumping in foreign markets and be restricted through high tariffs to discourage their demand. So foreign government can then intervene by increasing tariffs on those exports so that they won't be cheap. And that will be leading to what? It will lead to them not highly demanded abroad. Local firms cannot compete in the open market. So with more dependence on the government support, if the government can withdraw its support from these businesses, they cannot be able to compete openly in that open market because they are used to depending on the government through all of these incentives and subsidies. So local business cannot compete in the market where where subsidies and incentives have been removed, because they've been made to be more familiar with that support. So if the support is no longer there, they cannot afford to stand on their own, so they will be leaving the foreign market. If government withdraw its subsidies, these firms cannot survive in the open market competition, and as a result, they will be forced out of the market due to the fact that there will be no longer government subsidies and incentive given to these businesses. They cannot stand the actual cost of production if all benefits offered by the government are withdrawn. So if the state takes everything as that was the support, they cannot stand the actual cost of production, cost of transportation, cost of storage, and the cost of research and development, cost of advertising. It will be a problem for them. Then they will be forced out of the market. Inefficient production. Producers who receive incentive from the government lose creativity and innovation. Yes, they become less creative and less innovative because they are always supported by the state through incentives and subsidies. They often fail to cut their cost of producing efficiently because there is always an extra support given by the government to them to produce more goods and services. This creates producer competence and at the expense of the consumer. So they will not be able to improve their goods and the standard of their goods to be modernized because of what? Because they are highly subsidized, they are relaxed, they don't see the importance of improving their product so that they become more efficient due to the fact that they are highly supported by their government. Increase in tariffs and costs. The cheap subsidized product for which their prices cannot be matched by local producers can result to retaliation. So that will mean foreign countries can retaliate by imposing more tariffs on South African exported goods themselves. So government can retaliate by imposing more import tariffs and import quotas on South African export to make them relatively expensive abroad, to ensure that they don't drive out their local businesses out of the market. This erodes the spirit of the World Trade Organization and the free trade. Remember, WTO wants countries to implement the free trade, whereby there will be no tariffs imposed against each other. However, with the retaliation, they won't be able to achieve that objective. Now we move to the import substitution. In this case, we are replacing former imported goods and services with the locally produced goods and services. So the import substitution is the part of South African international trade policy. So look at this. The government can either implement export promotion or import substitution. If the government implements export promotion, it tries to ensure that our local goods are produced and sold abroad so that they will be competitive in foreign markets. They get international exposure. However, if the state intervenes by implementing import substitution, it also wants to diversify our economy by ensuring that former imported goods and services are mainly produced locally. We replace former import with the locally produced goods and services to diversify our economy, to ensure establishment of businesses within the country. So that is import substitution. So there is a replacement of former imported goods with the locally produced goods and services. Import substitution is the replacement of goods that were previously imported with the locally produced goods and services. The import substitution policy can occur in two forms. So like I've mentioned before, there is the forced import substitution as well as voluntarily import substitution. Forced import substitution occurs when the country is forced to produce certain goods on its own because it has been sanctioned or excluded to take part in the part of the international trade, if the country has not been allowed to trade internationally through sanctions and embargoes, that will mean now the country will have to produce some of the goods on its own that were former imports. Like Zimbabwe was sanctioned for years, but we have seen that those sanctions have been lifted against the country. So the country was forced to produce some of goods on its own because it was unable to trade with other foreign countries because of sanctions. Voluntary import substitution occurs when the country decides to improve its industrial base by producing some goods and services that were former imports. So the country will simply decide to say, okay, we used to import these goods, but then we want to establish our own industry that will produce these goods. Therefore, we are stopping them from being imported because we can also be able to produce them. That is done to improve the industrial base within the country. So what are the reasons for import substitution? Diversification. So when goods that were previously imported are produced locally, domestic manufacturing expands and an economy becomes less reliant on the foreign sector. So it reduces dependency on the foreign sector because those goods will then be produced locally. Industrialization is promoted. The development of new industries to produce previously imported goods can increase tax revenues and create jobs for our economy. Balance of payment problems. If deficits on the balance of payments is too high, a decrease in import can help to rectify this what we call this deficit. So because imports will be reduced while maybe our exports are increasing the trade. Developing countries' reliance on natural resources as a basis for growth and development, it limits their ability to grow. If ever they depend most on natural resources that are not even transformed to final goods and services, that result to them not growing easily in the foreign market. So it is very important for them to transform their natural resources to final goods so that they will less depend on foreign countries and also be able to grow and trade with other world countries on value-added goods and services. If these resources are used to produce goods and services which can be used domestically or exported, economic growth might be increased. Then we continue with some reasons. So now we go straight to methods. Remember, the import substitution is not the part of an essay. However, you can come across a question under additional part requiring you to go an extra mile to discuss maybe the effectiveness of import substitution in South Africa as a part of an additional part for export promotion because they are under the same main topic. Tariffs, import duties, excise duties, or import taxes are imposed. These are known as taxes on imported goods and services. They take a form of different parts of or types of import duties or taxes, namely the specific import tariffs, and then also they take a form of development tax. They also take a form of the third one. We have the specific one. We have development, which the specific is on the product per unit. And then ad valorem is based on the luxury of the product that is imported. How durable is the product? And then we have the combination that combines both the specific as well as the ad valorem import tariffs. Then we continue. Import quotas. These are limits on the volume of goods to be imported that are set or predetermined by the government. Foreign exchange control, that's when the government or Reserve Bank intervene by imposing some rules and regulations on the demand for South African rand abroad that can be exchanged. Also ensuring that those people that demand South African rand can request it or apply for it via South African Reserve Bank. Diverted trade, that's when the government intervenes by ensuring that it neutralizes the trade, ensuring that it's difficult for importers to import goods and services. That can also be done in a form of ensuring that there are some delays on giving licenses for importers to import those goods and services, ensuring that there are high quality standards so that those goods that are at the lower standards cannot be imported in South Africa. We have a physical control whereby the state intervened by banning those goods not to enter the country at all. Those are part of the trade embargo. The subsidy, that's when the state intervened by giving subsidies to local goods, local producers to produce those goods that were former imported so that there can be improvement of South African industrial base. So these are methods. Import tariffs, we talk about import duties, excise duties or import taxes. This is the same thing. Those are levies that are imposed on South African imported, on imports to South Africa or on goods that are imported, that are exported by South Africa that are received as imports abroad. A tariff is a tax on imports. They are introduced for the following reason. So, mainly to protect local producers against the foreign unfair competition. Remember, if ever those goods from abroad are relatively cheap because of economies of scale, the government has the power to introduce import tariff to make those goods relatively expensive if those goods can also be produced by local businesses to provide the government revenues. It's also important to ensure that the government is able to earn revenues on imported goods and services to make imports more expensive and therefore discourage them. If imports are becoming expensive while they can also be produced locally, or those goods can be produced locally, consumers can simply decide not to demand imports because they're expensive, but then demand the locally produced goods and services of the same nature because imports are relatively expensive. But tariffs are separated into specific import tariffs, ad valorem import tariffs, as well as the composite import tariffs. Like I've mentioned before, the specific import tariff is the import tariff that is imposed on the product per unit, while the ad valorem import tariff is the tariff that is imposed on the product based on the durability or if it's a luxury or not. And then the composite is a combination of both the specific import tariff as well as the ad valorem import tariff. Import quotas or import limits. These are limits in terms of the quantity or the volume that is predetermined by the government to be imported on the specific product. Our government can intervene by setting some limits or quotas on the product to be imported so that it allows also local businesses to be able to produce on its own the same product. So import quotas involve placing restriction on quantity of goods that can be imported. So helping to ensure that the size or the amount of those goods is stated. So this takes the form of two. We have the general import quotas or import limits. We also have discriminatory. If it's general, it means that all countries are treated the same way to say you are allowed to import the size of this particular product. If it's discriminatory, that's when the country chooses to say country A will be importing less, but country B will be importing more of the same product. We call that discriminatory import tariff. This is done to reduce quantity of certain goods that are imported if the country can also produce them. Remember, it is impossible for the country to substitute the importation of some goods that it cannot afford to produce. So the country can only substitute goods that it has a capability or ability to produce. That's when we can have import substitution. Import quotas influences the supply and the price of imported goods. Remember, if ever the government is setting the limit of goods to be imported or reducing the volume of goods to be imported, that will result to less supply, and those goods will become relatively expensive in South Africa because of less supply. Import quotas can be general or discriminatory, like I've mentioned before. The general ones means all countries are treated the same in the particular product. They're importing the same volume. But if ever it is discriminatory, one country is told not to import more of the particular product while other countries are importing more. That's a part of discriminatory import tariffs. The foreign exchange control. So these are methods as they continue. The government can limit the amount of foreign currency available to importers. If ever importers want to import goods, remember, they must pay those goods using that foreign currency. So the government can limit the amount of that currency available to the importers so that it will be impossible or will be difficult for them to pay for those goods and say they are willing to import. The government can make it impossible for them to receive that foreign currency. There will be more restrictions. Those that are in need of that foreign currency must apply through the Reserve Bank. So for them to pay for those imports, they need the foreign currency from that particular country where imports are coming from. Without necessary currency, it is impossible to import goods from the rest of the world. All foreign exchange earnings by residents are handed over to the central bank. So whoever that is in need of those currencies must apply through the central bank. Those who need to make foreign payments apply to the central bank, who ration them. Then we continue diverting trade. Diverting trade refers to the measures taken by the government to make it difficult for importers to import goods and services. So there are some of the delays that are put in place by the government to ensure that the importers are unable to import their goods as they wish. It takes time until they decide to give up on importing those goods and services. We talk about import deposits. That's when now goods to be imported, if the firm is willing to import some goods and services, that will mean that there should be a deposit to be paid in prior, which is equal to the value of the good to be imported. That makes it very difficult for the importer to import that particular product because of the deposit to be paid in prior. Government requires importers of certain goods to make a cash deposit equal to the fixed percentage of the value of the good that has been ordered. Administrative obstacles. That's when the government make it very difficult also for those business to import their goods and services. There will be some delays of some sort in a form of giving them relevant certificates, giving them their visa. That will make it difficult for them to bring their goods in South Africa because now they cannot enter the country without the relevant paperwork to bring their goods and services. That delays. So the time-consuming custom procedures or significant levels of paperwork will discourage potential importers from bringing their goods in South Africa. While there is a delay that allows local businesses to keep on producing those goods for the local market. This includes certificate delays by the local government, delay on issuing traveling documents, delay in trading licenses. This discourages those importers from bringing their goods because as these delays are keeping on, that will result to them even deciding not to import their goods into the South African economy. We continue with the diverting trade, the quality standards. This is when the government intervened by setting high quality standards of goods that can be imported to the country. Those businesses that are producing goods at the poor standard will not be allowed to bring those goods into the South African economy. That will then be allowing our local firms to keep on producing those goods without any unfair competition from abroad. The quality standard, the government can impose high quality standards that could deter potential importers. These include the health and safety standards, environmental standards, and also patents as well as copyright that will be making it difficult for importers to import those goods and services. These standards act as protective measures if domestic producers are exempted from these standards. Remember, it can happen that domestic producers of the same goods can be exempted from these standards. They won't be considered on this standard, but only importers will be considered. So that give them the upper hand, that give local producers of these products upper hand to keep on producing compared to importers, because importers now are not exempted. They have to be in line with these standards that have been predetermined by the government. Imports are required to meet those predetermined standards to earn approval into the local or domestic economy. If ever they don't meet these predetermined standards, they will never enter or given access to the South African economy. Physical control. In this case, we talk about the total ban of goods from the country because of some reasons. It can be because the product is a demerit or is harmful into the society or is of the poor quality. Then it can be banned completely from South Africa. That's a part of the physical control. So the trade embargo is imposed on the import of certain goods from the particular country. And then that's a total ban or trade embargo. This might be because of goods are harmful in the society or they are of the poor quality. When certain products are banned, they forfeit legibility in the country. They cannot be able to enter the country because they are completely banned from entering the domestic economy. So advantages of the import substitution include increased employment opportunities. So when goods and services that were formerly imported are now produced locally, that will lead to greater demand for labor. We know that there will be more demand for labor and more employment. Improvement of the country's balance of payment. If imports are substituted, they are restricted from entering the country. That allows local firms to produce those goods domestically. So in that case, it can happen that we continue with our export under export promotion and we restrict some import that we can be able to produce. So the volume of import coming in will be less than export, which will be giving advantage to our balance of payment. Imports are leakage in the economy and it results to the outflow of money. If former imports are locally produced, the money stays within the economy. There will be less outflow of money from the economy. promotes countries' independence. The country can no longer depend on other countries. The country will no longer be dependent. It will be self-sufficient, meaning it will be able to produce variety of goods without having to depend in other countries. Countries that successfully implement import substitution are less dependent on other countries because they are able then to produce goods on their own. We continue. Increase consumer choice and economic diversity. This allows local consumers to have variety of choices within the economy because variety of goods will be made available in the domestic economy. Also, there will be economic diversity because there will be more goods made available by the domestic economy into local consumers. That's why we are saying local consumers benefit from variety of choices from goods and services produced locally. The local economy can be independent, which promotes the country's self-sufficiency and economic diversity because now they are able to produce all those goods that they were not able to produce before. Result to new business being established. Yes, the government offers some subsidies to businesses to produce goods that were former imports. That allows those businesses to be encouraged to produce those goods and services. Then new industries will be established and encouraged by those subsidies. A support by the government can result to the establishment of new businesses in a form of voluntary basis or forced substitution, like I mentioned before, that they can be voluntary or forced substitution. Easy to implement. So by using tariffs and quotas, it makes it more easy and effective to implement import control measures. They also ensure that local production and growth are not compromised because if ever these restrictions are in place, they will be mostly focused on the local production than depending on the foreign producers to bring goods into the South African economy. Emerging economies cannot afford. So in this case, we talk about disadvantages. What is bad about import substitution? Remember, it is bad because those developing countries or newly industrialized countries might find it difficult to replace some of the goods because they lack some basic resources such as capital and equipment. So it will always be difficult for them to substitute some of the goods that were imported. So if they substitute them, they will be going without them because they are not capable in the form of capital, in a form of technology, and in a form of labor expertise. Therefore, it will be difficult for them to substitute those goods and services. Isolation from the internal competition. If ever countries are deciding to implement import substitution, some countries can get together and isolate them in the foreign market. They can find themselves being sanctioned or banned from trading with other world countries. Consumers pay higher prices for local goods. Yes, because of less competition. Remember, if ever goods are no longer made available in a form of importation, that will be reducing competition for local producers, resulting to them charging higher prices because of less competition, resulting to them also producing poor quality of goods and services because they are lacking the competition. They will be less efficient and also they won't be innovative and creative because they are protected by the government through the tariffs and quotas. Retaliation. Foreign countries can intervene by imposing same tariffs on our export, making it difficult for us to export our goods and services, depending on the government for protection. So local firms can then depend most on government for their protection instead of being efficient. If ever the government can stop protecting them, they can collapse because they'll be facing the open market competition whereby there will be no government intervention or control. Competition will be decreasing. So that will mean there will be less competition in the market due to the fact that the government intervened by restricting imports not to come in large volumes. So that will lead to our businesses being less innovative due to the fact that they are not exposed to the high competition in the open market. Inefficient production. So local firms will be very much inefficient in the production because of less competition that is pushing them to be efficient in the market. Unsuitable technology. So they will be using outdated technology because of what? Because they don't have that technology that is required, that is modernized currently. High total cost. So there will be high cost for producing goods and services because they won't be exposed to the modernized technology that allow them to produce at the economies of scale and at the lower cost. Emerging economies cannot afford to decrease imports of certain goods. South Africa is a capital poor country and technological poor country with the lack of investment in machinery and equipment. We rely very heavily on imports from other countries in terms of capital and technology. our lack of capital resources reduce our ability to produce certain goods for consumers. So then consumers will then import those goods. It does not necessarily lead to an overall reduction of imports. To manufacture consumer goods, we import capital goods and intermediate goods from other countries. So if ever we impose tariffs from them heavily, they can decide not to sell us those imported machines and capital, which will lead to us not being able to transform our natural resources. It is going to take many years before we would be able to produce luxury goods. Therefore, we must import them. So if ever we restrict some of the imports, we can be sanctioned from not receiving those imports from other countries or from those luxuries from other countries, which will be bad for the economy. Isolation from international competition. Local business might be isolated from the international competition because they are protected by government. It can result to them being unable to compete effectively internationally. Consumers pay higher prices for local goods. Local producers produce goods may be more expensive than imported goods, as local businesses might not be very efficient due to lack of competition. This might compromise the quality of local goods compared to the imports. Okay, we continue with that one. And then let's check another one as a disadvantage, retaliation. So in this case, countries can retaliate by imposing more tariffs on South African exports. Retaliation might also include physical bans and sanctions of some South African exports in the foreign market. This can increase the scarcity of some basic capital goods, as the country might be excluded from competing or interacting with specific countries in the world. And then dependent on the government production. So local firms might not be able to compete in the open market where there is no government intervention. Government production reduces competition and decrease the level of efficiency for local businesses. This might lead to local consumers buying poor quality or deficient products from the local markets because of our firms are less efficient. And then we are done with that one, move straight to the desirable mix and economic integration. In this case, we talk about the use of both import substitution as well as export promotion simultaneous, and checking how do countries normally choose to make use of these policies. Import substitution and export promotion. Import substitution and export promotion should not be used as in the opposite way, because the aim is to achieve the same objective. Many industrial countries started out by protecting their domestic industries and then applied export-oriented policies after considerable length of time. Import substitution can lead to export promotion. Remember, if ever we block imports, then we produce more goods. We can have high volume of goods that can be sold also in other countries. We can lead to export promotion. Some countries were not successful in starting with import substitution, then they moved to the export promotion. Why do they normally fail? They fail because of they normally depend on most of other countries for them to receive some goods and services, because their local markets are having less capital to produce goods and services. They lack labor expertise to produce some goods and services. And also foreign countries can intervene by retaliating. So to prevent that, you rather implement export promotion than doing import substitution. Import substitution, as we continue, some other developing countries may also benefit from focusing on export promotion instead of dealing with import substitution. A dual strategy of combining both import substitution and export promotion is also possible if ever the country will be strategic on implementing these policies. It is true, though, that recently those countries focusing on export promotion outperform the countries that focus on import substitution. Why? Because import substitution is a problem. Countries can retaliate in the bad way, which will lead to your goods not being exported also. So it is fair to promote export to the foreign market than blocking goods from entering the country. So either way, if you are given a chance to analyze this, your argument will be giving you a mark. It depends on the sound of your argument on this, because both of these policies are very important. Promotion is good because it allows our firms to be competitive abroad and our goods to get international exposure. However, protecting our local firms so that they can produce more goods and also improve our local production. So there will be the same objective to be achieved by implementing these two policies simultaneously. And then protectionism and free trade. Once a country has decided with what a mix of free trade or protection best suit their economy, it needs to find the countries that are having the same objective that can be used to achieve the goal. This will ensure trading partners are chosen that are willing to trade under those conditions that have been set by those group of countries. Trade agreements that are set, the rules of trade are called the trade protocols. So we'll be moving straight to the trade protocols now. So trade protocols have the combined effect of increasing amount of trade that occurs between countries, but also restricting it by laying down rules for the way in which it can occur. So there will be principles that will be followed. Trade blocks make use of free trade and protection. So there are these things that we call trade blocks, whereby countries get together to form those trade blocks so that they can trade easily with other with themselves or with each other. We talk about the likes of the BRICS. You are familiar with the BRICS. It's a part of the trade block that was formed to ensure that member countries are able to trade effectively with each other without having to impose high tariffs amongst each other. Member countries pursue free trade with one another, but apply the trade restrictions on non-member countries. Economic integration now. So if we talk of economic integration, we talk of a trade protocol. Economic cooperation refers to any combined action taken by two or more governments in partnership to promote the interests of their countries. So they have a common interest, so they decide to form the trade protocol so that they will be trading with each other effectively. However, what do they do differently? They don't impose tariffs against each other, but they impose tariffs against non-member countries on the trade protocol. Economic integration refers to the removal of trade barriers that restrict the free flow of goods and services, as well as the effective interaction between world countries. If countries are deciding to form economic integration, they will be removing those trade restrictions that were imposed before to allow them to have the simple movement of goods and services amongst each other. That lead to what we call the globalization. Free trade areas. So they take a form of the 4 items which include the free trade areas. So in the free trade areas, we refer to the situation whereby the member countries or countries form the group and decide to trade with each other freely without imposing any tariffs against each other. However, they will be imposing tariffs against the non-member countries that are trading with them. Then we also have the custom union, whereby the free trade areas are developed even further, whereby the member countries remove all trade restrictions between themselves and apply same trade restrictions against non-member countries. Look now, this one is not the same as the free trade areas because they implement the same trade restrictions. On the free trade areas, the restrictions against non-member countries were not similar or were not the same. However, in this case now, under custom unions, all trade restrictions or tariffs are the same against non-member countries, and no country has a right or the power to influence the tariff that we agreed upon without any formal discussion with other member countries of the trade protocol. Like I mentioned, no country can reduce or increase restrictions without being in the conversation with the custom union agreement or member countries of the custom union. Then we develop it further to the common market. In this case now, this trade agreement is growing because now there will be a free movement of capital and labor between the member countries. So custom unions have taken one step further, where member countries decide to increase the level of economic integration between each other. So what happens in this case? There will be free movement of labor, the capital and money between borders of the countries. These countries that are forming the trade bloc will be able to move the capital and equipment as well as money freely among each other. But with non-member countries, there will be restrictions. People may live and work wherever they wish in the common market. If ever we're the bloc with a certain country, South Africans, we can work anywhere where we are the part of the common market without restrictions imposed by the government. Economic and monetary union. This is the biggest or largest economic integration. Now, that's when now those member countries take a further step of using the same currency, using the same central bank, and also implementing same fiscal and the monetary policy. That is known as economic union or economic and monetary union. Member countries agree on to adopt single currency, the same central bank, for determining the monetary policy, like interest rates. So they work commonly in there. Taxes are also made uniform as members adopt the common fiscal policy. That one is the largest economic integration. So that was the content I had for you today. The next one will be some questions relating to the content I've just explained. So this is the assessment. Remember, there's also a worksheet available for you in the Word document that you can use to revise for this topic. Section B, how does export promotion affect the balance of payments of a country? Remember, when you're doing the BOP, we spoke about exports being less than imports will lead to trade deficit. However, now in this case, if ever there's export promotion, it allows our export to increase faster than imports, which will lead to what? It will lead to our, our BOP, our current account facing the trade surplus or the current account surplus, because there will be more inflow of the current as a payment for export than the outflow of the currency. Remember, we're talking about current account, the both visible and invisible exports. Export promotion increase the volume of export, resulting to the inflow of foreign currencies. If exports increase rather than imports, a trade deficit on the balance of payment will be reduced. How does the increase in imports affect the economy? If imports are more, what will happen? A rising level of imports cause trade deficit on the balance of payment. An increase in the import can distort countries' balance of trade and devalue the currency. Evaluate the impact of export promotion on local industries in South Africa. So, the positive impact. Bigger export markets allow local businesses to sell more products and generate more income or revenues. South African industries may produce goods at the large quantities and benefit from economies of scale. The average cost of production may be minimized, which allows local businesses to export products at the lower cost and competitive prices. Incentives provided by government, such as the concessions on transport costs, may increase the profits for exporters. Export subsidies reduce production costs and increase the competitiveness of exporting businesses on the international market. Local industries will become more innovative and produce better quality of products to gain competitive advantage in the international markets. Any other answer was accepted. That was correct. Negative. Producers who receive financial incentive from the government may lose their creativity and innovation in terms of productive efficiency. Producer may have false sense of security as subsidies distort the actual cost of production. Businesses that do not receive government financial support may find it difficult to compete on export markets. Export industries may lose the market when foreign countries retaliate by imposing tariffs and quotas on imported goods. Any other correct and relevant response was accepted for 8. So this is an essay now discussing detailed export promotion with regards to reasons, methods, and disadvantages. Now, this is for 26 months as the main part. The additional part, evaluate the success of import substitution as a South African trade policy. So in this one, I will be quick because it repeats the content that I've already discussed in there. So normally we have introduction, which will be the part of the lower order response. Export promotion is the use of incentives and subsidies to encourage domestic manufacturers to increase their productivity to sell them into the foreign market. And then any other correct relevant response is accepted for 2. Reasons for export promotion. The country achieves significant export-led economic growth, and then the export promotion enlarges production capacity of the country caused by a greater foreign demand. And then export markets are much bigger than local markets. Local goods may be highly demanded abroad, resulting to the improved efficiency. Larger production units create a job opportunity, increase economic activity. It leads to lower retail prices because of high production at the lower cost paid. Approaches. Incentives. The government supplies information to export markets in order to stimulate the exports. And that's where we talk about market research. Other examples are research on the new markets, concessions on the transport, charges as well as the export credit. Pre-advisory schemes and business intelligence are given to exporting business to improve their efficiency in the global market. Subsidy. Incentives which encourage exporters to increase the amount of their production. It includes direct and indirect subsidies. Direct subsidies can be cash payments to exporters as a support to decrease the cost of production. indirect subsidies, refunds on import tariffs and general tax rebate. And then we continue. Trade neutrality. Subsidies equal to the size of import duties are paid by the government back to business. Neutrality can be achieved through trade liberalization. Then we continue. Disadvantages. Lack of competition. Incentives and subsidies reduce prices and force competitors who may be able to create sustainable and profitable businesses out of the market. Total potential trade is therefore reduced with subsidies rather than without subsidies. Increase tariffs and quotas. Other countries may retaliate with the tariffs and even quotas when similar goods are sold domestically below their real cost of production. Powerful businesses can afford to offer similar products at the much lower prices. Those are multinational industries. Compared to their production, the subsidized businesses, businesses' domestic market may be so small that it will destroy the business who receive the subsidy. Distorted pricing. Subsidies distort prices as they do not show the true reflection of the cost of production. Subsidies lower the cost of production incurred by the businesses, resulting in goods sold at the lower cost abroad. Local subsidized businesses may not stand an open market where there is no government intervention, so they will be driven out of the market if ever there are no subsidies. Local subsidized business may not stand on open market where there is no government intervention if subsidies are withdrawn by the government. Production of labor-intensive industry. Developed countries often maintain high level of effective production for their industries that produce labor-intensive goods, in which developing countries already have or can achieve competitive advantage. We talk about agricultural produce here. They mainly subsidize and protect those. Export promotion results to the protection of labor-intensive industries by developed countries. That was for 26 months. Any other discussion that is correct and relevant also allowed. Evaluate the success of import substitution in South Africa. And then it's been successful for the following reason. Creating a gap for investment with domestic boundaries, redirecting resources to the production of goods, leading to the formation of new markets or new industry, leading to increased profits, which impacted positive on saving, investment, and capital flow. Continue with the additional part. Boosting domestic industrialization that enhanced domestic labor-intensive industries that created job opportunities by using latest technology. Increasing the resilience of to global economic shocks by building economic stability and sustainability. Facilitating urbanization through expanding industries, restricting imports created and increase demand for locally produced goods and services. Unsuccessful now because of the following. It led to lack of external competition that affected efficiency of infant industries negatively, affecting the growth of the. It failed to meet the needs of the growing domestic industry that resulted in black markets. Illegal markets were created because of the import substitution, meaning goods were imported without the agreement with the government. So they formed a part of black or illegal market. Financial leakages took effect, reducing government revenues on overall capital base of the economy. Trade protection due to import substitution led to overvalued exchange rate, causing the rise of domestic prices. We continue unsuccessful. It forced government to spend more on subsidizing local industries investment. So inflation followed. Capital and entrepreneurial talent are pulled away from industries and developing countries to countries who have competitive advantage in the total amount of imports are not reduced, as South Africa still imports specialized products as well as capital or loans and intermediate goods to produce goods locally. Then this is the conclusion, which must be the higher order response. It must accommodate either the main part or additional part, or both of the main part and additional part. It's very important for you also to know that it must not be a repetition of any information mentioned or discussed in the topic. So, in the light of the negative impact of the free trade, it is critically important to protect smaller developing economies against uneven competition from the developed country. any other correct and relevant response and in the higher order is accepted for the maximum of 2 marks, then you will stay with 40 marks.
After all, I think we are ready.
I think